Welcome back to the channel. In this video, the focus is on trading volume and how to read it so you can spot potential shifts in market direction with more confidence. What volume actually is? Volume is simply the number of units traded in a given period of time. In forex, it reflects the total amount exchanged in terms of currency. In stocks, it is the number of shares. In futures, it is the number of contracts. And in crypto, it is the number of coins traded over that time window. Traders and investors watch volume because it shows both liquidity and how much money or how many units are actively changing hands, which reveals how interested the market is in buying or selling that asset. Why volume matters? Both short-term traders and long-term investors use volume as a core part of their analysis. Technical analysts study volume alongside price to judge the strength behind a move, while fundamental analysts use it to gauge participation and conviction in reaction to news or earnings. On its own, volume does not say where price will go next, but combined with price action, it helps reveal the current direction and any potential change in trend. How volume appears on charts. On most price charts, volume is shown as vertical bars at the bottom, usually colored green for up candles and red for down candles. Each bar represents the volume traded in that specific time frame, such as the number of Apple shares traded in one day on a daily chart. Green bars are typically treated as buying volume and red bars as selling volume, although every transaction always has both a buyer and a seller. So the bar really measures total activity in that period. Price moves with different volume. Imagine stock X trading at $10. In one case, a buyer pushes the price up by $1 by buying 100 shares, and in another case, a buyer pushes it up by $1 by buying 10,000 shares. Price has moved the same distance in both scenarios, but the second move shows far greater participation and buying interest because many more shares traded at the higher prices. When volume expands sharply, it usually signals that something meaningful has changed and traders are suddenly more eager to buy or sell, which is why reading volume with price helps measure the real strength behind a move. 3 main uses of volume. Volume is most commonly used to confirm trends and judge their strength, to confirm potential reversals, and to confirm breakouts through important levels. In all 3 cases, the key idea is the same. Strong moves in the direction of the signal should be backed by noticeable increases in volume to be considered more reliable. Volume confirming strong trends. When price is trending up or down and volume increases in the direction of that move, it usually shows that the trend is healthy and supported by strong interest. For example, during an uptrend, if price consolidates in a pattern like a triangle with fading volume and then breaks out upward on rising volume, that expansion in volume suggests buyers are stepping in aggressively and the trend is likely to continue. In a downtrend, growing volume on the declines shows sellers are active and committed, which often leads to further weakness as long as that participation remains strong. What pullback volume tells you? Ideally, during pullbacks or corrections against the main trend, you want to see lighter volume and then higher volume again when price resumes in the direction of the trend. This pattern suggests the trend is still dominant and the temporary counter moves are relatively weak, increasing the odds of continuation. If pullbacks begin to happen on higher volume while trend moves occur on lower volume, it can be an early sign that the existing trend is losing strength and may transition into a range or even reverse. Decreasing volume in trends. When price keeps pushing higher or lower, but overall volume is fading, it often signals waning interest and a weakening trend. In an uptrend, rising prices with steadily declining volume show that fewer buyers are willing to participate at higher levels, which increases the risk of a pause, range, or full reversal. In a downtrend, falling prices with shrinking volume suggests that selling pressure is drying up, again opening the door for a potential reversal or sideways phase. Exhaustion moves and volume spikes. A sudden, sharp price move accompanied by an extreme volume spike can mark an exhaustion move rather than strength. These are bursts where volume surges far above its recent average, sometimes several times higher, and often appear near the end of a mature trend as the last wave of buyers or sellers rushes in. After this kind of climax, the trend frequently stalls or reverses because the dominant side has effectively run out of fresh participants to push price further. Volume confirming breakouts. When price breaks a key support or resistance level, a trend line, or a chart pattern boundary, volume becomes crucial for confirming that breakout. A valid breakout is usually accompanied by a clear increase in volume, showing that many traders agree with the move and are willing to trade at the new prices. If price slips through a level on very low or unchanged volume, the move is more likely to be a false breakout that may fail and snap back into the prior range. Final thoughts on volume. Volume is one of the most important tools in technical analysis because it helps judge whether price moves are strong, weak, likely to continue, or at risk of reversing. By itself, volume does not predict direction, but when read together with price action, it reveals how engaged buyers and sellers are, which gives valuable insight into current trends and potential turning points.